Hi, welcome back. At the start of every year, I play my version of Moneyball. For those of you who've never heard of Moneyball, it's a book written by Michael Lewis about Billy Beane, the general manager of the Oakland A's, who managed to keep his team in contention with a bare bones budget but with a reliance on numbers. It's all about trusting data. And I essentially, at the start of every year, play my own version of Moneyball. What I do is I collect data on every publicly traded company that I can get my hands on. Actually, collect is too strong a word, gather the data, and I analyze the data to the best of my ability, and I do a series of posts on that data. What I thought I'd start this year's series with is about the data itself. And I'll start with a confession. I'm a number cruncher. I'm a natural number cruncher. I've historically relied on numbers. But I've learned through hard experience that as number crunchers, we share some delusions. The first is the notion, the delusion that numbers are precise. I say only half jokingly that the reaction of a number cruncher to uncertainty is to add more decimals, as if making a number look more precise will make it more precise. In fact, it's not the case. In fact, the very fact that we're collecting numbers about business, markets, and investing should tell us that numbers are imprecise. The second delusion is that numbers are objective. We take issue with storytellers for being biased. And you know what? Numbers are just as biased. In fact, they're more dangerous because it's easy to hide your biases behind a number than in a story. And the third delusion is somehow by getting a number on something, we're getting in control of it. So we think that by attaching a number to risk, we're controlling risk. By attaching a number to return on capital, we're coming up with good projects. Numbers cannot give you control. So numbers are imprecise, they're biased, and they don't put you in control. So you may say, why do you keep collecting numbers? I remain somebody who has faith in numbers, but that faith now is tempered by the fact that I know the games that people can play with numbers. So as you look at my numbers, I'd like you to keep these delusions in the back of your mind, because you should know that I am not approaching this data as a completely objective person. My biases will be in the data. I'll try to be as open as I can about those biases, because that's all I can do. In fact, just as an aside, as you all know, big data and data analytics have become the buzzwords in lots of businesses, and I remain a skeptic. And part of my skepticism comes from having worked with lots of data. After all, financial markets were the original basis for big data. Having worked with big data for a long period, here are my 3 reasons why I don't think big data is going to be the profit-making machine that its biggest promoters make it out to be. The first is, I've learned, again through hard experience, that data is not information. In fact, I've described annual reports as data dumps, not information sources, because people have, I think, replaced the need for information with just providing lots and lots of data. So not all data is created equal. In fact, I would argue that data that is based on actions, things you do, is worth more than things you say that you will do. In the context of my data, here's where it's going to show up. When I talk about equity risk premiums for US markets, I could report survey data. There's data out there, what people tell you the equity risk premium is, but I'm actually going to focus on what they pay, because that's really more reliable. Keep this in mind as you increasingly see databases start to incorporate social media data, Twitter and Facebook data. I know that's the way data analysis is going, but be cautious, be careful what you wish for. The second is drawing on an old notion in business of competitive advantages and edges. If everybody has big data, nobody has big data. So if every company can collect everything about you and they know everything about you, the edge that they can have with that big data becomes much more limited. So for big data to have value, you have to have some degree of exclusivity, either because you and only you have access to that data, or you've discovered some proprietary way of taking that data and converting it into information. And already you can see why in finance there might be big data. There's a lot more data than we used to have 30 or 35 years ago, but in a sense everybody has it. It becomes much less profitable to have the big data. And third, not all data is actionable. For big data to make money for a company, they've got to be able to use the data to either alter existing products or services or come up with new ones. In fact, if you look at those 3 criteria, you can see why Amazon and Netflix are the paragons of big data. In fact, the best examples of use of big data. they collect actionable data about what we do. Amazon in terms of what we buy, and Netflix in terms of what we watch. It's exclusive. They and only they have access to that data, and they can use that data to alter their products and services. Amazon in deciding what to show us when we look for things to buy, and Netflix in terms of not just the shows that they reveal to us, but in terms of the new shows that they come up with as they develop new content. So can big data work in finance? I remain skeptical because I don't think these three criteria are easily met with financial data. And that's part of the reason I feel no qualms about sharing my data. It's not as if I can make immense amounts of profits by having this data. Might as well share it with others so they can use it as well, because nobody here has an edge on this data. So having said that, let me give you an insight into the process details of how exactly my data goes from raw data to what you see on my website. And if you're not interested in using my data, skip this entire section. It's really not worth it for you. I'm going to start with the data gathering, how I get the raw data. Then I'm going to move on to how I classify that raw data into geographical and industry groupings. Then I'm going to talk about how I analyze the data, what the metrics I focus in on and why. Then I'm going to talk a little bit about computational details, because it's something that we gloss over but can make a huge difference in the numbers you actually see. Then I'm going to talk about how I report the data and how you can access the data and perhaps use it. So let's start with the raw data. The reason I say I don't say the word collect raw data, because it suggests that I sit there looking through the raw data, collecting it. I really gather the data, and that's one of the great advantages you have in 2017 as opposed to 1954. When Ben Graham had to do his screens to find cheaper stocks, he had to hand collect the data. I don't. I use a bunch of different services. I use S&P. I use S&P Capital IQ, which I absolutely love, a great database. I use Bloomberg. I used to use Value Line, no longer use them. I also use a host of specialized services for lots of different reasons. Moody's for sovereign ratings, PRS for country risk scores. At my count, I use about 10 different raw data services to kind of put together my big data set. And I look for every publicly traded company for which I can get a market cap number, a market cap greater than 0. So that's my only criteria. So I don't screen the data. And at the start of 2017, for my January 2017 database, I ended up with 42,678 companies. It's a monster Excel spreadsheet. It takes me about 5 minutes to make any changes in it. But that is really my raw data. Now, to give you some perspective, I get this data on January 1st of 2017. So while the data is as of 2017, a note of caution. For market data, market cap, stock price, interest rates, the data is as of the close of trading on December 31st of 2016. For accounting data, remember, accounting data doesn't get updated by day. The accounting data as of January 1st, 2017, if it's the last fiscal year, might actually be 2015 data. But almost all of my metrics are computed using trailing 12-month data, which is data usually through September 30th of 2016. You're saying that's not consistent? Actually, it's perfectly consistent. If you're an investor trying to make an investment in early January 2017, that is the data you will have. Updated market data as of that day, and accounting data as of September 30th of 2016. So keep that in mind as you look at this data. Now, in terms of classification, I classify the data on two bases. First, geographically. And let me give you some perspective on what the data looked like in January 2017. My biggest slice was emerging markets, partly because I put everything in there. Africa, Asia, not including Japan, Latin America, Middle East are all in there. 20,578 emerging market companies. There are about 7,330 U.S. companies, about 3,679 Japanese companies, and 6,655 developed Europe companies. That includes the EU, Switzerland, UK, all of Northern Europe. And you say, why these classifications? I'm kind of stuck with these because of history, because that's how I've classified my data for the last 24 years. And I feel a little queasy about breaking that down. Actually, within emerging markets, I do also sub-report China and India as separate markets for those people who might be interested just in those countries. I also break the data down into 94 industry groupings. Now, these groupings are my concoction, but they're a concoction based on other people's concoctions. I start with S&P, Capital IQ, and Value Line industry groupings, and I've created my own 94. Again, these are groupings I've used for the last 5 or 6 years, so you can compare things across time. So that's how the data is broken down, and as I start computing the numbers, I'd like you to keep in mind where the data is coming from. Now, the way I compute my metrics reflects my corporate finance and valuation roots. Reflecting my corporate finance bias, I break the corporate data down into profitability and return measures. I report margins, I report returns on capital, returns on equity. I report debt ratios, debt to capital, debt to equity, book value and market value base. I report dividend payout ratios. I also incorporate buybacks for US companies because it's an increasingly common way in which they return cash. So I report my numbers on profitability, leverage, and dividend policy sections. My valuation focus leads me to look at things that I need for my discount rates, my risk premiums. I report equity risk premiums and default spreads for bonds. I report risk parameters. In particular, I report betas for companies by industry groupings. I report cash flow numbers, working capital, capital expenditures, acquisitions. I report growth rates, both historical and sustainable. I also look at pricing numbers. I look at earnings multiples, PE ratios, PEG ratios. I report book value multiples, price to book value, enterprise value to invested capital, and revenue multiples. Again, you can see that the breakdown of numbers reflects my biases. At my count, I have about 50 different industry data sets, and the number I add 1 or 2 each year, and I'm reaching a point where I don't think I can add any more and update them in reasonable time periods. Now, in terms of computational details, one of the things I've learned in the years that I've been doing this data is how you compute numbers can make a huge difference. And the differences arise from statistical issues. In fact, there are 2 statistical issues you face anytime you face a database of this size. The first is sampling biases. As you compute some metrics, you're going to start losing companies. And the more companies you lose, the more you're exposed to sampling bias. The second is when you have 42,678 companies, you're going to get some outliers. A company with a PE ratio of 53,000. You're saying, so what? As you compute your averages, those outliers can make a difference. So I've had to wrestle with this issue for 25 years, and I'll give you an example with PE ratios to illustrate how much of a difference it can make. One of the numbers I like to compute is a PE ratio by sector. So if I want to compute the PE ratio for steel companies collectively in the US, here's what I can do. I can take the average PE ratio across the companies that have PE ratios. I can take all US companies, compute the PE ratio for each company, and take a simple average. What's wrong with that? First, I will lose about 25 to 30% of my companies because they have negative earnings. I can't compute a PE ratio. That's sampling bias. Second, if one of the remaining companies has a huge PE ratio as an outlier, it's going to pull up my average. So here's what I do for almost all of my ratios to get a number that I think is more reflective of the industry. And you might disagree with me on this. To compute the PE ratio for steel companies, I take the market cap of every steel company in my grouping, including money-losing companies. So I add up those market caps. Then I take the net income of every steel company in my grouping, and I add up the net incomes, including the companies that lose money. I divide the aggregate market cap by the aggregate net income. What do I get then? I use all of the companies in my group, so I don't lose any companies, so I don't have any sampling bias. Second, in a sense, it's a weighted average. So if there are big companies that trade at low PE ratios, that's going to show up in my bases. So with PE ratios, I actually report the aggregated PE. I also report the simple average PE in case you want to see the differences. But computational details matter, and I will try to be as clear as I can whenever I report a ratio of how I compute it. But for the most part, my ratios, my returns on equity, returns on capital, profit margins are computed using the aggregated numbers. Now, in terms of reporting, I report the data I don't report company level data, and I'll tell you why. I have to be sensitive to my raw data providers. I don't want to end up being competition for them because, after all, they make money selling the data and they give me access to the data. As a result, you will not find company level data. I do have the data and it's for me, but no, I can't share the data much as I would love to. I also report the current data. So this data you will see classified by geography and by industry grouping on my website. And you'll also see archive data going back to 1999 for the US and going back about 5 or 6 years for the global data. Why only 5 or 6 years? I didn't think people would actually look at the archive data. I always thought the current data was the only thing people cared about. And even that, I didn't think that many people would be interested. But I've discovered, for whatever reason, people want to access the archive data. So you can find the archive data on my website. Finally, in terms of access, you can see the data online by clicking on the appropriate link, or you can download the Excel file. My recommendation is look it up online, but then download the Excel file. The Excel file will give you a lot more flexibility. In fact, my cost of capital files, you can actually change the risk-free rate and risk premium, and all the numbers will get updated. You can download Excel files either for the global data, or you can do it by region: US, emerging markets, developed markets, Japan, and the rest, or for just India and China. Just a note of caution on the data for India and China. You can get some strange looking numbers, even on an industry basis for India and China, because the sample sizes get really small for some of the sectors. So just as in closing, I'd like to take you through my website to show you how to access the data. So if you get into my main website, which you can do by typing in demodern.com, this is what you will see. So just type in www.demodern, my last name.com. You say, if you click on data, you'll see my starting page. So this is where you will get into, and you will notice the data is broken down. I give you 5 categories. Take a look at the about data. It gives you the history of the data, the timing of the data. I've given you a little bit of the background already. The second, if you click on the breakdown, it'll give you the data as of now. So it'll give you what we just talked about, where the data comes from. But here are the key links. If you click on current data, you will actually see the current data as of January 5th, 2017. So let's take an example. For discount rates, let's suppose you want to look up levered and unlevered betas by industry. If you click on this link, you'll see the HTML version just for the US, right? If you want, as I said, it's much better to get the Excel. If you click on any of these links, the Excel spreadsheet with the betas classified by industry will download. So you'll see the data for the 5 regions and for just India and China. And you will see actually the breakdown, first for discount rates, then for return measures, EVA, which are excess returns, either on a firm level or an equity basis, capital structure, the dividend policy, and you'll see basically the links and the Excel spreadsheets with each. At the bottom, you'll see the multiples: earnings multiples, book value multiples, revenue multiples, EBITDA multiples. And finally, at the very bottom, I also have standard deviations for equity and firm values in case you are interested in valuing options. One final note is you're welcome to use whatever data you find on the site for whatever reasons. If you want to acknowledge me, great. If you don't, that's fine as well. I know some of this data gets used in legal settings. Just as you're fine using it as long as I don't become part of that conversation in court. This data was never meant for legal purpose. It was meant for people doing valuations in real time and corporate finance in real time. But if you find other uses for it, you're welcome to use it and share the data with others. I'm glad to share the data. I'm glad that it's of use for some people. So thank you very much for listening, and that's about it.